Hi everyone, welcome to my YouTube channel Learn Commerce with Namita. I am Namita Mane. In today's video, let us start with a new topic, income from house property. In this video, we are going to cover introduction, what do you mean by income from house property, types of house property, format of house property, and calculation of gross annual value. So without wasting time, let's start the session. Now first we'll try to understand what do you mean by income from house property. Now see, the income arising out of house property either in the form of rental income or on its transfer is referred to as income from house property. Now see, any person who is the owner of house, if that owner is getting some money in the form of rent from the tenant is called as income from house property for that owner. Now for example, suppose Mr. A is having one house. This house he has given on rent to Mr. B. So whatever Mr. B is going to pay the money to Mr. A in the form of rent to Mr. A, that will be considered as income from house property for Mr. A. Okay, so A is the owner of the house and B is using that house. So for using that house of A, B is paying some money. So that money is called as rental income for Mr. A. So what do you mean by income from house property? Any person who is the owner of the house, he is getting some money, okay, in the form of rent from the tenant is called as income from house property. Now this income is taxable. Okay, whatever income the owner is getting in the form of rent, that income is taxable under the head income from house property. Okay, if the following three conditions are satisfied. So the property should consist of any building or land appertaining thereto. Second point, the assessee should be the owner of the property. Third point is, the property should not be used by the owner for the purpose of any business or profession. If these three conditions are satisfied, then whatever income is arising from that property will be taxable under the head income from house property. So what are those three conditions? I will repeat again. First, the property should consist of any building or land appertaining thereto. Second is the assessee should be the owner of that property. Third is the property should not be used by the owner for the purpose of any business or profession. Now suppose Mr. A is the owner of that property and Mr. A is if Mr. A is using that property or that house for his business or profession, then this will not come under the income whatever will be generated from that property will not come under the income from house property. It will come under the next head of income from business or profession. So if these three conditions are satisfied, then the income generated from that type of property, it will become under income from house property. I hope you have understood that what do you mean by income from house property. In simple word, in short, any person who is getting some amount of money in the form of rent from tenant, it will be considered as income from house property. Now next is classification or type of house property. Now there are three types of house property. First is self-occupied house property. Second is let out house property. Third is deemed to be let out house property. So there are three types of house property: self occupied house property, let out house property, deemed to be let out house property. Now first in detail we'll try to understand what is self occupied house property. Now the property which is used for own residence by an individual or by Hindu undivided family are known as self occupied property. Now suppose Mr. A is using the house, okay, for his own residence purpose, then it will be called as self occupied house property. Okay, he is using the house for his own residence where he is living with his family, then it will be called as self occupied house property. Now next is let out house property. Now the property which is given to other person by charging some amount of rent, it will be called as let out house property. Okay, now suppose Mr. A has given his house to Mr. B. So the whatever Mr. B is going to pay to Mr. A, so this house will be turned as let out house property. See, the property which is given to other person by charging some amount of rent, it will be called as let out house property. So Mr. A has given his house to Mr. B, okay, and Mr. B is paying the money in the form of rent to Mr. A. So this house for A will be what? Let out house property. Why? Because Mr. A is not living in this house. If Mr. A is living in this house, then it will be called as self occupied house property. But here he is giving the house to B to live in that house, to stay in that house. So this house, from this house he is generating some type of income. So that's why this house will be called as let out house property. Clear? Now next type of house property is deemed to be let out house property. Now when the person has occupied more than 2 houses for his own residential purpose. Now any 2 houses according to his choice can be treated as self occupied house, and other houses will be assumed as deemed to be let out as per Income Tax Act. Now what does deemed to be let out house property means? Now suppose Mr. A is having total 5 houses he is having. Now out of these 5 houses, if he is out of these 5 houses, as per the act, he can show that 2 houses will be self occupied and remaining 3 houses, even if this 3 houses is not on rent basis, if it is vacant also, still as per the act, these 3 houses will be considered as deemed to be let out house property. So read the definition again, that when the person, okay, when the person has occupied more than 2 houses for his own residential purpose. So 5 houses Mr. A is having. Out of these 5 houses, he can select any 2 houses for his residential purpose. So these 2 houses will be considered as self occupied houses, but remaining 3 houses will be assumed as deemed to be let out. Even if there is no income from these 3 houses, still those 3 houses will be considered as deemed to be let out house property. Now next is exempted income from house properties. Now some income from some type of property will not be taxable under Income Tax Act. So income from agricultural farmhouses will not be considered or will not be taxable under the head income from house property. So these are the income which are exempted from income from house property. So first is income from agriculture farmhouse, then income from palace of an ex-ruler, means the king and queen, if they are having the palaces, so that from the income which is going to be generated from palaces will not be considered for taxable in income from house property. Then property income of local authority, then property income of an educational institution and hospital are not to be treated or they are exempted from income from house property. Then property income from charitable institutions. Charitable institutions means like some institutions like temple, then some charitable hospitals. Okay, so the income whatever is going to be generated from that type of property are exempted under this head. Then property income from an approved scientific research association is exempted from this head. Then property used for business or profession is exempted from income from house property. So these are some type of properties or income from property which are exempted under income from house property. Now for the calculation purpose or for calculation of income from house property, there are some important terms which you should know. Okay, first is municipal valuation. Now what is municipal valuation? Now this is the value as determined by the municipal authorities for levying municipal taxes on house property. Now every municipal corporation, okay, now in Pune Municipal Corporation, there they charge some type of house tax. Okay, so this tax is called as municipal tax on house property. Next is fair rent. Now fair rent is, it is the rent which is similar property can fetch in the similar or similar locality if it is let out. If the house is let out, then there will be a fair rent. Next is standard rent. Standard rent is the rent which could be which is permissible under the law to be charged to tenant. Okay, so standard rent is a rent which could be permissible under law to be charged to tenant. Next is annual rent. Annual rent means the amount payable by now annual rent means the amount payable by tenant to owner in respect of each year, that is rent for 12 months. Now for example, the tenant, between owner and tenant, it is decided that every month the tenant will give 1000 rupees for owner, okay, as rent. So then every month will be, the owner will get 1000 rupees. So for 12 months, how much the owner will get? 12,000 rupees. So this 12,000 rupees is what? Annual rent, okay, which the owner is going to get and tenant is going to pay to the owner. So annual rent means the total, means the amount payable by the tenant to owner in respect of each year, that is rent for 12 months. Second point is unrealized rent. Now unrealized rent is the portion of your house rent amount which is not realized from the tenant. Now for example, as I said that every month the tenant is going to give 1000 rupees to the owner. So 1000 multiplied by 12, 12,000 amount means 12,000 rent is expectable that the tenant should pay to the owner. Okay, now in case sometimes the tenant did not pay the rent for 2 months. Okay, so that means 2000 rupees he did not pay. So this 2000 rupees will be called as unrealized rent. Okay, means 2000 rupees he did not pay to the owner. So how much money did the tenant pay? 10,000 rupees he paid. So 2000 rupees he did not pay. So that portion will be called as unrealized rent, which the tenant did not pay to the owner. But in place of 12,000 he paid 10,000, but 2,000 is what? Unrealized rent. Next point is loss due to vacancy. Now property is available for let out but was vacant during the whole or any part of the year. Now for example, if one house, okay, suppose for 6 months the house is vacant, means there is no there is no income or there is no tenant who is living in that house for 6 months. So then for 6 months there is a loss. Okay, and who is going to suffer the loss? Obviously the owner. So then that loss will be called as loss due to vacancy. So property is available for let out, means the house which is available for let out means which is available to give for rent to the other person, but during that year, okay, or during for any month the house is vacant, then it will be called as loss due to vacancy. Now let's move to the next part, that is format of income from house property. Now first of all we have to prepare, okay, we have to calculate the income from house property. So there are some steps. So this is the first step, or you can say this is the format which you are going to prepare for the calculation of income from house property. As per the requirement of your question, you are going to prepare the format. Now first of all you need to understand, or you need to identify the nature of house, whether it is let out house property, or it is deemed to be let out house property, or self occupied house property. Okay, let out house property means what? The person has given his house to other person, okay, on rent. That will be called as let out house property. Deemed to be let out house property means what? Suppose a person is having more than 2 houses, okay, suppose 3 houses, 4 houses, whatever. So out of those 4 houses, 2 houses will be considered as self residence, and remaining 2 houses will be considered as deemed to be let out. And self occupied house property means that a person, the owner himself, he is using that house, okay, for his residence purpose, then it is called as self occupied house property. Now first of all, in each type of house, okay, whether it is let out house property, deemed to be let out house property, self occupied house property, you have to calculate gross annual value. Okay, gross annual value. So after you find the gross annual value, you have to less the municipal tax paid by the owner. Now after you deduct the value, you will get net annual value. Okay, net annual value. After you get the net annual value, there are some standard deduction under section 24. Okay, so this standard deduction you have to less. So first standard deduction is standard deduction under section 24A, that means 30% of NAV, means 30% of net asset value you will less. So suppose if 10,000 is the net annual value, okay, so on this 10,000 you have to calculate 30% and deduct it under section 24. Next point is interest on borrowed capital or borrowed loan, that is under section 24B. So suppose if the owner has taken a loan on house or for renovation purpose the loan has taken. So whatever loan that owner has taken, the interest on that loan will be deducted under section 24 subsection B. And after you deduct all the values, the final answer you will get, that is income from house property for let out, for deemed to be let out, and self-occupied house property. So this is the major format of income from house property. Now the most important point which student has to remember is the calculation of gross annual value. Okay, so next slide is calculation of gross annual value. So I hope you have understood the format, okay, whether it is let out house property, deemed to be let out, or self occupied house property. This will be the format, okay, for annual first is annual gross value. From annual gross annual value, you have to deduct municipal tax paid by the owner. Then after you less, you will get the amount as net annual value. Then deduct the standard deduction under section 24. After you deduct, you will get the final amount that will be called as income from house property. Now first this thing is what in the format. First is what? Gross annual value. So for calculation of gross annual value, you need to follow the 4 important steps. After you follow the 4 important steps, you will get the final value that will be called as gross annual value. Okay, so see the nature of houses, okay, house property. On that basis you need to calculate the gross annual value. So for first we will take the example of let out house property, okay, then deemed to be let out, and self occupied house property. So for calculation of gross annual value, okay, first step is what? Find the maximum amount from the following step, okay, find maximum of following. So that means first step is what? To find the expected rent, okay. So expected rent, okay, to calculate accepted rent, first is what? Municipal value. Second is fair rent. This will be given in the question, okay. First case we are looking for let out house property, okay. If in example the question or that question is about let out house property, then take the value of municipal value and fair rent, okay. Then identify from this two, municipal value or fair rent, whichever is maximum or whichever is high, you will take the amount here, okay. This is your first step, okay. Next is what? Whatever is the maximum value you get, compare it with standard rent, okay, and then find the minimum out of the standard rate. Now for example, see, suppose the municipal value is 10,000 rupees. Suppose municipal value is 10,000 rupees and fair rent is 5,000, okay. Now from this two value, which is maximum? 10,000 is maximum. Clear? This example I am giving for what? Let out house property, okay. Suppose municipal value is 10,000, fair rent is 5,000. So which is the maximum amount or which is higher amount from this two? 10,000. That means municipal value is more, so maximum amount. Now next is what? Find minimum of the following. Now maximum amount is what? 10,000. So this 10,000 is what? Municipal value. And suppose standard rent is 15,000. Okay, standard rent is what? 15,000. Now what does the step 1 means second point says that find the minimum of the following. Means check the minimum amount from the from this thing. Municipal value is more, maximum, so hence we have taken maximum value, okay. So from these two figures, okay, from this two figure, identify which is minimum, which is less. So maximum amount is 10,000, standard rent is 15,000. Okay, so which is minimum? 10,000 is minimum. Okay, so 10,000 is what? Expected rent. Okay, so step 1 is what? We have got expected rent, that is step 1. Clear? Now for example, suppose fair rent is 10,000 and municipal value is 5,000. So which amount you will take? You will take the fair rent amount. Why? Because it is maximum. Then next come what? Fair rent you took as maximum amount, and standard rent is 20,000 rupees, or suppose standard rent is 5,000 rupees. So maximum amount is 10,000, standard rate is 5,000, maximum amount is 10,000, and standard rent is suppose 5,000. So from this two, okay, which amount you will take? The minimum amount, that will be standard rent. Okay, now for here 10,000 is minimum amount. So hence we have taken 10,000 as accepted rent. Okay, so step number 1. Now step number 2 is what? Find the rent received or rent receivable. That is what? Adjusted and actual rent. Okay, now in the previous slide I explained you that what is annual rent and unrealized rent. Okay, so step 2 is what? Find rent received or rent receivable. So now for example, say for annual rent, okay, if the person is giving 500 rupees as annual rent, okay, so 500 multiplied by 12 means what? 6,000 rupees. So annual rent is 6,000 rupees, and from this 6,000 rupees the tenant did not pay for 2 months. Okay, so 500 multiplied by 2 is what? 1,000. Okay, this 1,000 is what? Unrealized rent, because the tenant did not pay to the owner. Annual rent is 6,000, unrealized rent is 10,000. So remaining is what? 5,000. Okay, so this 5,000 will be what? Adjusted annual rent. Okay, or this 5,000 will be called as rent received or rent receivable. Step number 2. Okay, now step number 3 is what? Compare step 1 and step 2. Okay, so now step 1 is what? 10,000 rupees we have got the value. Step 2 value we got 5,000 rupees. Okay, this 5,000 rupees is what? Rent received or rent receivable. Now we have to compare step 1 and step 2. Okay, whichever is higher or more. Okay, now which is higher, step 1 or step 2? Step 2 is 5,000, step 1 is 10,000. So which amount you will take in step number 3? The higher amount, that is 10,000 rupees. Clear? Okay, now from this 10,000, next step is what? Step number 4, less loss due to vacancy. Okay, now for example, the loss due to vacancy is suppose 1,000 rupees is the loss. Okay, so 10,000 minus 1,000, amount is what? Remaining amount 9,000. So this 9,000 is what? Gross annual value. For which type of property? For let out house property. Clear? Okay, see, step 1, find accepted rent. Step 2, find the rent received, okay, or receivable. Then step number 3 is compare step 1 and step 2. Check whether step 1 amount is more or step 2 amount is more. Whichever is higher, write in step number 3, and from that amount less the loss due to vacancy, that is step number 4, and final amount you will get 9,000, that will be called as gross annual value. Okay, this step you have to follow for let out house property. If the nature of house is let out house property, then you have to follow this step. Now case number 2 is what? If the house property is deemed to be let out house property. Okay, deemed to be let out house property. Then if the nature of the house is deemed to be let out house property, then you have to only find, or you have to only do till step number 1. Okay, step number, from step number 2 to step number 4 is not applicable in the case of deemed to be let out house property. So whatever amount, okay, will be getting as accepted rent, okay, that is 10,000 rupees, will be considered as a gross annual value. Okay, gross annual value. So for deemed to be let out house property, step 2, step 3 and step 4 is not applicable. Only step 1 is applicable. Okay, step 1, with what in step 1 what you have to do, compare, first of all compare the value of municipal value and fair value, whichever is maximum, write it here. Then check the maximum value and standard rent, whichever is minimum will be called as accepted rent. Okay, and remaining steps you do not have to do. So whatever is accepted rent, that will be considered as gross annual value in the case of deemed to be let out house property. Now in the case of self-occupied house property, okay, so self-occupied house property, these steps means step 1, step 2, step 3 and step 4 is not applicable. Okay, why? Because the owner is using that house for his own residential purposes, so hence he is not getting any income, hence self-occupied, this following steps will not be considered for the calculation of gross annual value. Okay, now this is very important, okay, for the for calculation of gross annual value. Next, after once you get the gross annual value, okay, in case of let out house property, deemed to be let out house property, self-occupied house property, you have to prepare the format. Okay, so in the format, gross annual amount you will write. Okay, so gross amount for let out house property was what? 9,000. Okay, 9,000 was the gross annual value, and for deemed was 10,000, and this is nil. Okay, because gross annual value will not be there for self-occupied house property. So gross annual value 9,000. If there is any municipal tax paid by the owner, reduces, suppose he paid 1,000. Okay, so remaining balance is 8,000. Okay, so 8,000 is what? Net annual value. Clear? Then deduct less deduction under section 24. This is compulsory to do. So 30% on 8,000, write the amount here, and if there is any interest on borrowed capital or loan, write it here, reduce it from the net annual value, and final amount will be called as net income from house property. Same for deemed to be let out house property also. If there are any municipal tax paid, reduce, and then the amount will be income from house property. And here self-occupied property, the gross value is nil, hence there will be nil for net annual value also, and whatever the final amount is there, it will be considered as income from house property. Clear? So in this way, thank you. So in this way you have to prepare or compute the income from house property. These steps are very important. Okay, the format, this format is very important. In the format, first point, that is gross annual value. Okay, for calculation of gross annual value you have to follow this step, but before you follow this step you have to check the nature of the house. Okay, what is given in the question? Suppose in the question it is given that find the house is the let out house property. So for let out house property, follow this step. Deemed to be let out house property, follow this step. And self-occupied house property. Okay, so thank you very much. I hope you have understood today's session. Thank you very much. Please subscribe my YouTube channel, like and share the video, and do not forget to press the bell icon to get the latest notification.